Going once, going twice, sold! You're listening to the Property Pod.
Today is how do you pick a real estate agent?
Yes, so
That can be a couple of different things. Agents are now probably better educated as well as to what properties are going to sell for.
talking about it over coffee when we used to just catch up for coffee and not record it. You talk about it in a way that's accessible and easy to listen.
If you've been in your career for a short while, how do you take yourself to the next level?
Yeah.
It was
Start
really
a podcast.
Yeah,
Clearly.
exactly right. Yeah, epic voice.
This week on the Property Pod. All right, guys, welcome back to the Property Pod. Your easy to listen to and accessible way into the property market. I'm Aaron Horn, your host, and I'm joined as usual by 414 Property Co. real estate agents John McGregor and Patrick Berry.
Good morning.
Well, I think that's the first time we've announced it as a Property Co, isn't it? I like it.
Yes, I want to start launching it as kind of a Property Co. Event.
Yeah.
I was talking to my mother during the week, who was a keen listener of the show.
Yep. And
she was like, oh, I'm really excited and really liked your explanation of how everything went down with the colours and the branding and the future of the company, Pat.
Oh, that's exciting.
Yeah. So, and well, it's compliments all round. So you got a compliment for your branding. And then she said to me, she says, oh, John's all the places he goes speech, I still think about it. Holy moly, mum.
I like to reflect on the glory days as well.
Peaked in high school.
It was peaked in high school, yeah.
All right. So last week on the show, I mentioned that we may be trying to get our friend of the show, Andrew Leggett, back in. He's been kind enough to give us some of his time this morning. I know he's got a lot going on at the moment. So, yeah, Andrew, I will pull your mic up and good morning. Welcome back.
Good morning. Thank you for having me, gents.
Thank you for sitting so quietly through our attempts at starting the show.
Yeah.
You're already wondering why you came back.
Yeah, I was thinking, what is this?
Just quietly sitting further and further back in your seat.
It's all right, though. I've got the door blocked, so he's not getting out.
There's
exactly.
no escape.
Yeah.
So last week on the show, Andrew, you would have heard we were talking about the interest rate cut that's just kind of been announced last week. It was kind of big news in the world of...
Yeah, it was big news. It was highly anticipated. We had a hunch that we were going to get a rate cut.
Yep.
And it was interesting to see what some of the lenders and banks have done with it.
Yeah, so I think I initially saw that it wasn't picked up by the banks straight away or something like that, or was this something like there was like a little kind of backwards forwards of this may do something, this may not do something?
Yeah, that's right. So it was a bit of a slow play, particularly with some of the banks. They didn't drop any variable rates, but they did reduce their fixed rate position. So there's some great offers in the market at the moment.
How does that work? Like, how do they decide, like, oh, we're going to follow or we're not going to follow? Like, what's the basis of that?
They need to take a lot of things into consideration. One of those things is like high interest saving rates. So if they reduce the rates on lending, it's going to bring down the rates on the savings accounts. And there's many Australians out there that are living on interest.
Okay, yeah.
So they've piled their life savings into these accounts, and each month they're living on the interest. So these rate cuts are really not ideal for some people.
If you've got the cash storing your cash in the bank, basically. That's an interesting point, isn't it? Because all of a sudden, if they're like, well, I've got all this money just sitting in the account where, what do they call through fractional lending, the bank's using their money to re-lend. If all of a sudden they just continuously redraw that and put it somewhere else, now the banks doesn't have the money that they wanted to use on those accounts.
Yeah, that's it. Yeah, that's right.
Okay. Yeah, I haven't thought of it that way. So that I suppose right at these lowest levels have ever been as well, like how much further can they go in some ways before they just disincentivise their clients too much to say, well, I don't want the money in the bank at all.
Yep. So I don't feel for a product manager in a big bank. It's like a seesaw, and you've got to level it out.
Yeah.
Yep.
Yeah.
Yeah, this is going way over my head. Last week I thought, oh yeah, I've kind of got a grasp on it. I had a quick look, but so what I remember coming up was saying was like the cash rate or something is at 0.1%.
Yes, that's right.
What does that mean?
That's like the wholesale rate of money that when the banks borrow it from the Reserve Bank, that's what they're borrowing it at, and then you've got the markup for the retail rate.
Yeah. So that seems crazy low. Like that's just like
it is
nothing to nothing. They're saying it's a record low.
Record low.
Can it go lower? Will it go lower?
It can go into the negative. And that's a whole another show.
Yeah.
Yeah.
I'm not even going to bother trying to touch that.
I know this sounds stupid, but all I'm thinking of is Die Hard 3, where they go in to steal the gold from Fort Knox I'm just feeling like that's like if it goes into the minuses, they're stealing the gold from Fortnite.
Still on the gold. Yeah.
And we need a John McClane to come through. And mate, your haircut, John McClane.
I was about to say, I'll put my hand up.
Yeah.
Oh, right, that'll work.
John.
Yippee-ki-yay.
Yeah.
Well, so with, I mean, now, like, I know the couple of times we had you on before, which was asking sort of in a practical sense, what this is actually meaning for boots on the ground with people who do have their loans existing in place. Is it, again, another good time to review? Or, if you've only reviewed in 3 months, is it, I'm like, okay, we've just had that rate adjustment. What's the next step for me to do? And is it worth a phone call at this point?
Yeah, look, it definitely is to see what's out there. I've just recently had one of my existing customers come through and he needed a little bit of extra cash to do some home renovations. And when we looked at what rate he had been on, and then after a product conversion and a top up, he actually was saving money.
Oh, right.
Yeah.
That's
Even though he got
crazy.
more money.
He's got access to more money and saving money. That's madness.
Yeah.
Jeebus.
Yeah, so I'm seeing a bit of that at the moment.
Yeah, okay. When was it? I mean, in his particular case, how long had it been since he had a review? Can you remember?
It was only 2 years.
Only 2 years.
Yep.
Okay. Well, there's a fair bit obviously that's happened in that 2 years. So
It has, yeah.
But was that it? I mean, I'm assuming too. From if you're on a fixed term and it's going to give you 12 to 24 months. Now, does that mean there'll be a penalty if you review at that point? If you were to try to get out of it?
Yeah, look, that's correct. So when you do fix a loan, if you were to make a big change or discharge the loan, or try and refinance it, you're going to get hit with what's called a break cost. And there's no set way of saying it's going to be X
One way or another.
on this date. It all depends on what the costing of funding is doing at the back end and how long's remaining, etc. As to what that might be. To give you a bit of an indication, I fixed mine in coming on 3 years ago. Recently inquired to see what it was, and it was not feasible for me to break that loan.
Oh, wow.
Okay, yeah, that was going to be kind of my follow-up questions. Like, is with the rate dropping so much, is it something that you could think like, oh, I'm stuck on this one at the moment, but like the fees might be negligible. That's a hard word to say.
It can be, yeah.
You did well though.
Yeah, thank you.
I could see you really processing that.
My mouth was turning in weird ways. Yes, would it be negligible to do it? But kind of in your case, it's not. So it's the numbers are not your friend.
Not my friend, but I'm not saying that that's the case for everyone.
So
Definitely not.
It's a good example because think about it. You just gave us two good ones, like your client who it was worth him doing because now he's saving money. Whereas in your case, the problem is the cost of breaking out of that existing term. Yes, if you were to adjust it, week after that, you'd be on, less repayments. But unfortunately, the penalty cost of having that change outside of your fixed term is not worth you doing it immediately. Is that right?
That's right. Yep.
Okay.
So look, I can't remember how many months it was, but let's say it was going to take me 18 months to actually break even.
Oh, wow.
Yeah.
Yeah. Okay. So it's like, just wait till the term finishes. Yeah. Well, I know like when I first bought my house, I know if you go back even longer, they'll say 17% and all that stuff. But I know when did I first buy my place? Must have been around 2008, 2009, I think. And the interest rate of that for that property was 8.25%. And I had a 154,000 loan, which is sort of crazy now. Like get that little unit that I had up at Claremont for that. It's just not going to happen. So I mean, everyone has their time, but I know now, comparatively now with my interest rate on my investment property is significantly lower just because of all like the rates difference. And now I suppose is it a tough call to give? It's always the same with us too. Like there's never a perfect situation for everyone. People are thinking, okay, is now a good time to take out fixed terms or variable loans? I mean, it's an odd situation if the interest rate's like never been lower than it's ever been. It's like at 0.1, so something crazy. It'd hard to see how then you could lose on a. Is that the right word? On a fixed term at this point? Like what more is there to be done? Aside from the banks sort of trying to compete for the business at the lowest of levels.
That's right.
Are more people taking out that fixed term than they were in the past?
Certainly are. Yeah.
Okay.
And that's been a pattern that I've seen now for quite some time, particularly with your first home buyers.
Right.
Gives them their certainty of repayments for a set period of time.
Yeah.
But you make a good point. Like, what's there to lose now? The variable rates are still a little bit higher than the fixed, so they could come down. They might they might end up lower than the fixed. Who knows? So you might lose out there. But yeah, but I can't offer that advice to the clients.
Oh, of course not. Yeah, yeah. It's just give us some scenarios.
Yeah, give the scenario, present the facts. Here are your repayments. But yeah, I can't say you should do this.
Yeah, oh, exactly. It was sort of a spitball question, I suppose, in some ways, just thinking out
Yeah, you were
loud.
spitballing wild.
Yeah.
I was like, where are you taking
Yeah,
any
exactly.
of this?
Because that's the thought, like 3 years ago, I suppose, when, we looked at our own personal circumstances, when you fixed it, like this is a sweet, sweet deal. We don't know at the time.
That's exactly what I did.
Yeah,
Yeah.
yeah.
When I had the rate in front of me, I thought, oh, I've got to take that.
Yeah,
Yeah. Can't see it going any lower than that.
that's it.
So the thing I'm trying to work out now is like a few of the articles I'm reading are saying, this is good for clearly good news for mortgage holders and provide the economy with increased consumer spending. So lowering this cash rate is meant to, I keep hearing the word shot in the arm to get people spending more. So this is more stimulus to try and get people spending money in Australia. Is that correct?
Yeah, that's right. So what happens when the rate is reduced, when we're assessing the deal, we don't assess the deal on the carded rate. We had a buffer. So let's say back in the day when John was buying his property, let's say it was 8%. When we looked at the affordability, we would have added probably 2.5% onto that.
Okay.
When we calculated the repayments on the new loan. So if you think now, we've got offerings in and around the 2% mark, and you add the buffer in, the buffer is less than what rates were 4 or 5 years ago.
Yeah,
so
right.
it's opening up the door for maybe some more lower income earners to get in.
That's interesting just because there's this other article I was going to bring up today where it was in the Mercury last week about the areas that it's cheaper to buy than it is to rent.
Yeah, yeah.
So I guess that kind of piggybacks off that. Like some of the data that's come out on this. Sorry, I'm just reading through it as I go. The Aussie Home Loans Buy versus Rent report has come out saying Eastern Shore suburb Rokeby was named number one area where house buyers stand to save the most money by making the switch. So if you were to invest in a property there, be saving money. So something like this, positive news for people that are kind of in between that rental and purchasing world. There's kind of Risdon Bridgewater, Warrane, Primrose Sands, Dodgers Ferry are all kind of in this, you're paying $400 on a variable term or $594 on fixed, say example in Risdon Vale, where your rent could be $600 or something a week. So kind of seems to make sense that it's kind of stimulating the market into being like, yeah, buy.
Yeah. Look, these articles are great and it says go out and buy, but it's hard for some people.
Yeah. Well, again, the thing is too, is that there was, we actually answered this question for a friend of mine earlier on where she was in the situation where she wanted to buy, but because it was that rat race scenario where she had to pay the high rent, looking after her kids on her income. So therefore there wasn't a lot of residual income for her to continually put into that savings program.
That's right.
So there was no means for her to be able to, on her own, you'd say, to actually get a purchase contract anyway. So the only way then, you can revisit that is, you're looking at support where they've got those, obviously they have back then they didn't have the 5%, deposit scheme to avoid the mortgage lender's insurance. But she might not have had anyone to be able to actually go as a guarantor. So, therefore she can't get that deposit. So there are just some people that are just stuck in that little cycle. That's just, an impossibility to, I would never say impossible, but exceptionally hard to get out of. Hey, so
That's right.
as much as they'd want to, still getting that approval process is, just not going to be an option.
Yeah, reading down this article further, it kind of then breaks into that as like, as nice as it is to buy, it would be tricky to get in. While rents are higher compared to paying a mortgage, many renters in these areas are in the lower income demographic and may find it hard to save and find extra funds for a deposit.
Yeah, well, then even there's a friend of mine that there are a couple that are going through at the moment. They're just all of a sudden they'll get a nice little nest egg and then bang, get hit with something again, and then all of a sudden bangs up. Then all of a sudden one of the kids gets really ill, or it's a bang, and they get hit, and all of a sudden it's just gone again. So it's a real challenge, and I suppose it's a real deep empathy for anyone going through that, where someone will look, well, why don't you just buy it? It's like, well, sometimes life isn't that simple.
That's right.
We're obviously getting a lot of, because of all this, we're getting a lot of people that have been fortunate enough to be able to make that shift, and maybe they've been able to now, rather than buying 2 years from now with some extra savings, they've been able to do it now. And they're asking that question. I know we've looked at it before, but we're asking that, okay, what is that pre-approval process, and what does that actually look like, and what does it actually mean? Because I know I've had a few conversations with some buyers lately where they've said, look, I'm pre-approved, I've got the cash ready, I can buy a house now. I said, that's great. And it's not that simple.
That's right,
So,
yeah.
so what is that? What is that pre-approval process, and what does it actually mean?
Oh, look, we touched on it. I know we've touched on it in the past, and it's a great one to revisit. What I've seen, there's two types of pre-approvals. There's the type of pre-approval where you might walk into a branch and you'll sit down with a home loan manager and he'll look at your information and say, you're pre-approved.
Mm-hmm.
No credit decision has actually been made. No application's been made.
Oh, that's interesting. He's like, yeah, you got this.
Yeah, you'll be fine. You'll be fine. Just make sure you put a subject to finance clause in your contract and she'll be apples.
Ah, okay.
Yeah.
So kind of an informal pre-approval.
Yeah.
Yeah.
Let's call it an informal pre-approval.
Okay.
Pointless sounds a better word.
Pretty much, yeah. I think a better approach would be to apply for finance, a conditional approval. We tick everything off. We look at the savings, the employment, the credit history, the whole kit and caboodle.
This is where you go through like your spendings and everything, like you kind of how much you spend on your groceries, how often do you eat out, what we've gone through with sorting out my finance.
That's right.
We went through like, this is what you spend on your baby. This is all this stuff. Mm-hmm. Go through this process.
That's right. The full formal process, lodge a formal application through. And request a conditional approval. And what it's conditional on is providing a contract of sale and having a valuation done on that property.
Okay, so the one you kind of first mentioned is like the reverse of that. Like you will get a contract and we'll give you the money. And this one's like we'll give you the money when you get the contract.
That's right.
Yeah.
Yep. So John, if you come across a client and says, yeah, the bank's right to go, I've got the money, they haven't got the money.
That's right.
No.
Yeah.
Because they're never ever going to disperse loan funds without controlling the property and, of course, registering a mortgage.
Yeah, I remember we had many years ago an old salesperson who'd bring in to go, look, we've got a contract, it's cash. And I was like, oh yeah, let's have a look. And it said subject to finance, subject to building, subject to something. It was like, it wasn't, but I think he just got super excited. And what he was more so referring to was the idea that they've been pre-approved.
Yeah.
You know,
You're always so harsh on your dad. Like, gets a contract in and you just have to squash him down. Come on, John.
well, lucky enough, that wasn't Dad's story. That was one of our old salespeople.
Sorry, Chris.
That's fourth word for the episode. Was dig at Chris.
No, we did ask when we were chatting with my brother. Scott asked Dad when he come on the podcast. Dad's like, "Well, I've never even listened to it."
And he would have said it that matter of factly as well.
He really did.
I reckon if I asked my father about this podcast, he'd say, what's a podcast?
Well, my nan listens and she loves it.
Oh, it's good. That's excellent.
Well, I know that. I mean, the couple of key things you said there was, the bank's registering the interest, which, you know, in that case is the bank's taking out a covenant on the title, which says that you cannot sell that property anymore until their interest is paid out. But also to like the valuation process, because I've personally had a couple of contracts that have fallen through. It's only on first home buyers in this particular case for properties in a few different suburbs where on the second time round we haven't had any trouble. And on the surface, it actually seemed that we actually did have, and this will probably be for a discussion for another guest, but on paper, the two purchases look almost identical. A young couple around sort of the same savings, going to be, from they disclosed, about the same sort of loan to value ratio. However, from two very different valuations, one was nearly $50,000 apart. So on the first time round, it absolutely killed the deal. On the second time round, once we had a bit more supportive evidence for the valuer, they were like, "Yep, okay, we can absolutely justify that the price that you've paid for this property can be backed up by comparable sales, and therefore then the deal could proceed." Now, just so I've got that right, so in this, if there was a purchase contract for $400,000, for example, and then on a pre-approved situation, the client, you might say the client can purchase up to borrow up to $400,000. However, if just because they pay $400,000 for a property doesn't necessarily mean that the bank will lend up to it if a valuation only has the property valued at $350,000. Is that right?
That's correct. So the bank will come back and say, well, if the client's happy to proceed, we can use the valuation at $350,000, but then you're at your 90 or 95% lend of the valuation of that $350,000. Then the client's got to go find that extra $50,000.
Okay, interesting. So yeah, technically, you can pay any price you want for the property, and the bank will lend it on the proviso that they'll only lend up to the valuation, and whatever the difference is, you have to come up with the difference of yourself in cash.
Yep, 100% correct. So for a first home buyer, $5,000 shortfall on the valuation, that's a deal killer in most cases.
Yeah, interesting.
So when you go visit Sammy the Shark down there on the corner.
Yeah. What corners are that?
Where?
Yeah. Who do you know that we don't know, Pat?
We'll soon find out.
You see how I get all my deals done. At any cost.
That's recorded. All right, guys. I think for that, it's heating up in this studio box again. It's going to be another cracking day. We've all got things to do. I think we might finish up there. But thanks, Andrew, for coming in and just clearing up some of the stuff that went over our head in the last period. You're always good to have on the show, and I really appreciate your time.
Absolute pleasure. Thanks for having me.
Not a problem. Also wanted just to chuck a shout out to your photography award that you've won recently, the Pano Award.
Thank you very much.
Yeah, was it a bronze medal or a
bronze award?
Bronze award, yeah. So I don't know if you guys have covered this, but I'll just show you, John. This is a picture that Andrew's won an award on.
Oh, mate, that's amazing.
Isn't
Was
it?
Mortimer Bay? That's beautiful.
Thanks, mate.
Yeah, so shout out to that. Yeah, congrats
Thank you
on
very
that.
much.
Yeah.
Cheers. Appreciate that.
No, not a drama. It's always good to have your hobbies kind of.
Yeah, well, we're not just brokers, real estate agents, and media. Like we've got,
We do stuff.
yeah, we do stuff. We do have souls.
No, it's good to be awarded, and it's good to
Congratulations, mate. That's beautiful. That's
Thank
a great
you.
photo.
Thank you. Really appreciate it.
There you go, Pat. Have a squiz.
We better post that in the show notes now, for sure.
Yeah, we can definitely do that.
Let's link that.
I'm just worried
probably.
now that I've shown him that. Pat's like, oh, hold on a sec. I can get a photographer and a mortgage broker.
All in one.
All in one. What have I hired Aaron for? Oh, damn. All right, guys. We will finish the show there.
Yeah, it's a discussion for another day.
Next week,
All right,
Andrew
Mr.
Leggett hosting the property pod.
All right, Mr. Burns.
All right, guys. Thanks for that.
See you guys. See ya.
See ya. You have been listening to The Property Pod, produced and edited by 414 Media House in conjunction with 414 Real Estate and McGregor First National Propriety Limited.
This podcast is general information only, and the thoughts and views expressed is the opinion of our panel, and listeners should always seek and use their own investigation into any topic we discuss to ensure they fully understand their own situation.
It does not constitute and should not be relied on as purchasing, selling, financial or investment advice or recommendations, express or implied, and it should not be used as an invitation to take up any agent or investment services. No investment decision or activity should be undertaken on the basis of this information.